Disclaimer.
Hey my friends, here's Economics Exposed. Lock in because while the world is watching stock market dips, the engine of the global economy just seized. As we speak, credit spreads in London have exploded to 18 basis points. To most people, that's a boring number. To the banks, it's a death rattle. It means the lifeblood of the system, the credit that keeps everything from your local grocery store to global corporations running, is stopping. This isn't a theory, it's a $930 billion refinancing wall that just became impossible to climb. The last time spreads moved like this, we saw 2008. The time before that, the Great Depression. Today, I'm showing you the hidden data from the Fed's latest stress test and the exact moment the system broke. Wall Street is hoping you don't see this 18-point glitch until it's too late. The exit door is closing. Let's get into the numbers. Here's what makes this 18 basis point move so catastrophic. Every single day, corporations across America need to borrow money, not because they're failing, but because that's how modern business actually works. Your employer, the grocery store where you shop, the airline you'll fly on next month, they all rely on continuous access to credit just to operate normally. Think of it like oxygen for the economy. When that flow constricts, companies don't gradually slow down, they suffocate. This borrowing doesn't happen through your local bank. It happens in sophisticated markets where institutions lend to each other based on one critical calculation: the difference between what they can earn on a safe government bond versus what they demand to lend to a corporation carrying risk. That difference is the credit spread, and it's essentially the price of trust in the financial system. When banks trust each other and believe companies will repay their debts, spreads stay narrow. But when doubt creeps in, when lenders start questioning whether borrowers can actually pay them back, that spread doesn't widen gradually, it detonates. And that detonation is happening right now in London, in the Sterling Overnight Index Average Market, SONIA, which sits at the absolute heart of global dollar lending. According to the Bank for International Settlements, this offshore euro-dollar market exceeds $57 trillion, dwarfing the lending that happens inside the United States itself. When this market freezes, American companies feel it within hours. Let me show you why this 18 basis point move is so deadly. Imagine you're planning to refinance your mortgage, and overnight, every bank in your city simultaneously raises their rates and starts demanding extra collateral you don't have. You haven't changed. Your income hasn't dropped. Your credit score is identical. But suddenly, the lenders have collectively decided they don't trust the system anymore, and you're caught in the crossfire. That's what's happening to corporations across the developed world right now. The professionals on Wall Street aren't watching stock tickers when this number moves. They're watching history repeat itself with terrifying precision. In the summer of 1930, just months before the banking system collapsed and the Great Depression truly began, credit spreads in the London interbank market spiked to almost exactly this level. Banks stopped trusting each other to repay overnight loans, credit seized up, and companies that were profitable on Monday couldn't make payroll by Friday. September 2008 brought the same pattern. Lehman Brothers collapsed, and within days, these exact credit spreads blew past 20 basis points as banks hoarded cash and refused to lend to institutions they'd trusted for decades. The Federal Reserve injected hundreds of billions just to keep the plumbing functioning. And even then, we came within hours of total systemic collapse. Now think about what you're being told versus what's actually unfolding. Mainstream financial media wants you focused on whether the stock market will bounce back, whether tech stocks are overvalued, whether we're headed for a soft landing. All distractions from the real crisis in credit markets where the actual economy lives. Because here's the brutal truth Wall Street doesn't want you to grasp. Stocks can fall 30% and recover. We've seen it multiple times. Markets are volatile, investors panic, eventually things stabilize. But when credit markets seize, when the spread between safe and risky lending explodes like we're witnessing now, there's no quick fix. Companies can't wait for investor sentiment to improve. They need to make payroll on Friday. They need to pay suppliers next week. They need to roll over maturing debt next month. And that rollover is where the nightmare becomes reality. That $930 billion refinancing wall isn't just a number, it's a guillotine hanging over the corporate sector. According to S&P Global data, this debt must be refinanced this year. Not paid off, just refinanced, meaning companies need new lenders willing to extend credit to pay off the lenders from years ago when interest rates were near zero. Consider the math. These companies borrowed when the Federal Reserve had rates at 25 basis points, essentially free money. Now they're refinancing with the Fed funds rate still elevated and credit spreads widening by the day. What was a 2% interest rate on corporate bonds 5 years ago is becoming 6 or 7%, if they can even find lenders willing to take the risk. This refinancing wall isn't just about struggling companies that over-leveraged. Here's the part that should terrify you. According to Federal Reserve Bank of New York analysis, approximately 43% of all publicly traded American companies are now classified as zombies. They don't generate enough operating income to cover even the interest payments on existing debt. They survive only by continuously borrowing new money to pay interest on old money. When credit was cheap and spreads were narrow, this shell game could continue indefinitely. Lenders would roll over debt because there was nowhere else to put money that offered any return. But now, with spreads widening and lenders suddenly remembering that risk actually exists, these zombie companies are facing extinction. And we're not talking about obscure penny stocks. We're talking about household names, corporations with tens of thousands of employees, woven into supply chains feeding millions of Americans. Here's what makes this zombie situation exponentially more dangerous than previous crises. In 2008, zombie companies represented maybe 15 to 20% of the market. Today, at 43%, we're looking at nearly half the corporate sector unable to service debt from operations alone. They've been surviving on financial engineering, not business fundamentals. Stock buybacks funded with borrowed money, dividend payments financed through bond issuance, acquisitions paid for with cheap credit that mask deteriorating core businesses. Think about what happens when these zombies can't refinance. They don't just go bankrupt in isolation. A major retailer fails, and suddenly the commercial real estate landlord loses anchor tenant rent. The logistics company loses shipping contracts. The payment processor loses transaction volume. The advertising agency loses a major client. Each zombie collapse creates a cascade of secondary failures that spreads through the real economy like a virus through an immune-compromised system. And the banks know this. That's why credit spreads are exploding. Lenders are looking at their loan books and realizing they're holding debt from companies that can't survive in a normalized interest rate environment. So they're demanding higher spreads as compensation for risk they should have priced in years ago, and they're tightening lending standards at the fastest pace since the pandemic lockdowns. The 18 basis points represent the moment when the music stops. It's the canary dying in the coal mine, the early warning system that professionals watch while everyone else stares at stock tickers. When credit spreads blow out in London's Eurodollar market, it signals that the largest, most sophisticated lenders in the world are pulling back, hoarding liquidity, preparing for defaults they see coming over the horizon. Unlike stock market crashes that can reverse in weeks, credit crunches create self-reinforcing death spirals. Companies can't borrow, so they slash costs. Cost cutting means layoffs. Layoffs mean consumers spend less. Less spending means lower revenues for other companies, making them riskier borrowers. Widening credit spreads further, making it even harder to borrow. The spiral accelerates, and by the time the Federal Reserve reacts, we're already deep into recession. Your retirement account might show tech stocks and index funds, but behind those, equities sit corporations needing continuous credit access to function. When that access constricts, when the spread between safe and risky lending explodes to 18 basis points and climbing, these companies start making decisions that will eventually materialize in your quarterly statement as losses you never saw coming. This is the crisis hiding in plain sight. Not the daily market volatility that cable news obsesses over, but the slow-motion seizure of credit markets determining whether our economy can actually function. The 18 basis points in London aren't a warning of what might happen. They're confirmation of what's already begun, and the data from the Fed's latest stress test shows exactly how bad this is about to get. The Federal Reserve just handed us the roadmap to the crisis, and most people will never read it. On February 4th, 2026, the Fed finalized its stress test scenarios for the nation's largest banks. Buried in the technical language and economic projections sits a confession. They're preparing for a corporate bond market meltdown that makes 2008 look containable. Here's what the Fed is modeling in their severely adverse scenario. The unemployment rate climbs 5.5 percentage points to peak at 10% by the third quarter of 2027. Commercial real estate prices crater 39%. House prices drop 30%. Equity markets collapse. And the variable that should make every investor's blood run cold. Corporate bond spreads widen massively as lending standards tighten at the fastest pace since the pandemic lockdowns. According to the board's stress test documentation, the spread between BBB-rated corporate bonds and Treasury securities is projected to blow out significantly under stress conditions. We're not talking about gradual widening. We're talking about the kind of spread explosion that signals lenders have lost faith in corporate America's ability to service debt. And this isn't some distant hypothetical scenario. The Fed is testing for this now because the early warning signs are already flashing red in real-time markets. That 18 basis point move in SONIA spreads we discussed, it's not isolated. It's part of a global pattern of credit markets freezing as banks reassess counterparty risk across the entire lending ecosystem. Think about what SONIA actually represents. The Sterling Overnight Index Average, administered by the Bank of England, measures the cost of overnight unsecured borrowing between financial institutions. According to the Bank of England, SONIA is used to value around £30 trillion of assets annually. When spreads in this market widen, it means banks are demanding higher premiums to lend to each other overnight. They're hoarding liquidity. They're preparing for someone to fail. And the institutions watching these spreads most closely aren't retail investors. They're the global money center banks, the sovereign wealth funds, the pension systems managing trillions in assets. These are the smart money players who survived 2008 by reading credit spreads like tea leaves. When they see SONIA derivatives pricing in heightened stress, they don't wait for CNBC to confirm the crisis. They act. Here's where the math gets truly apocalyptic. According to MSCI data reported in late 2025, over $930 billion in commercial real estate loans alone will mature in 2026. That's more than triple the $300 billion scheduled for the second half of 2025. And this doesn't even account for the corporate debt maturity wall hitting simultaneously. S&P Global Market Intelligence documented how the commercial real estate sector has essentially been playing musical chairs with debt extensions. Loans that were supposed to mature in 2024 got extended to 2025. Then those got pushed to 2026. According to CRE Daily, nearly $936 billion in commercial real estate loans are now stacked into 2026 maturities, representing an 18.9% increase over the previous estimate. But here's the part that reveals this whole shell game is collapsing. When these loans were originated back in 2020 through 2022, borrowers were locking in financing at 3 to 4% interest rates. According to CRE Daily's analysis, the average rate on commercial real estate loans in 2025 hit 6.24%, up from 4.76% on the maturing debt. You don't need a finance degree to understand the problem. A property that could service debt at 4% can't necessarily handle 7%, especially when property valuations have simultaneously declined due to rising capitalization rates. And the lenders know this math better than anyone. That's why, according to Federal Reserve data, banks are tightening credit standards at the fastest pace since the pandemic. They're looking at their loan books, calculating how many borrowers can actually refinance at current rates, and the answer is terrifying them into defensive postures. The Fed's stress test scenario projects exactly where this leads. Under severely adverse conditions, banks face loan losses that would drive their aggregate Common Equity Tier 1 capital ratio down from 13.4% to 11.6%. That sounds technical until you understand what it means. The banking system absorbs nearly $550 billion in losses, while still maintaining minimum capital requirements. The banks survive. Your employer's ability to roll over its credit line to make payroll? That's a different question entirely. Look at what's happening in the first half of 2025. MSCI recorded nearly 150 commercial real estate foreclosures, the highest mid-year total since 2014. Two-thirds of apartment foreclosures involve loans originated in 2021 or 2022, when borrowing costs were still historically low. These aren't distressed properties in dying markets. These are assets that were performing fine when debt was cheap, but can't survive the refinancing reality we're in now. And according to MSCI's Jim Costello, 60% of troubled apartment loans mature in the second half of 2026, likely triggering a fresh wave of foreclosures. This is the slow-motion train wreck where you can see every car derailing in sequence, but the momentum is too great to stop. The corporate side is even worse. According to analysis from the Bank for International Settlements, the offshore Eurodollar market that finances international trade and corporate operations exceeds $57 trillion. This is the plumbing of global commerce, and it's seized by the same credit spread dynamics hitting SONIA markets. When London-based lenders demand higher spreads to extend overnight credit, that cost gets passed through every layer of the corporate financing stack within hours. PitchBook's analysis of the high-yield market shows over $700 billion in corporate bonds maturing from 2027 through 2029, including more than $350 billion in 2029 alone. But the real pressure point is 2026, where refinancing activity is expected to spike as companies rush to get ahead of the maturity wall before conditions deteriorate further. JP Morgan projects $225 billion in high-yield refinancing activity just in 2026. These aren't companies that can easily access investment grade rates. These are the riskier borrowers, the ones trading at spreads that already price an elevated default probability. When credit markets tighten and spreads widen like we're seeing now, these are the first dominoes to fall. And here's the feedback loop that makes this unstoppable once it starts. Companies can't refinance, so they cut capital expenditure. Reduced capex means they order less equipment, less software, less professional services. The vendors supplying those goods and services see revenue decline, making them riskier borrowers when their own debt comes due. Credit spreads widen further. More companies get cut off from funding. More defaults, more spread widening. Around and around the spiral goes, and there's no circuit breaker until the Federal Reserve steps in with trillion-dollar liquidity facilities. The Fed's stress test is modeling peak unemployment at 10% for a reason. That's not arbitrary. According to their framework, when corporate bond spreads blow out to the levels they're testing for, The cascade of business failures generates millions of job losses as companies liquidate rather than restructure. The unemployment spike isn't the cause of the crisis. It's the consequence of the credit freeze that's already beginning. And let's be crystal clear about the zombie companies we discussed earlier. That 43% of publicly traded firms that can't cover interest expenses from operations. According to Federal Reserve Bank of New York research, these companies have survived purely on their ability to continuously refinance debt at favorable rates. When that access disappears, they don't gradually wind down. They implode. Think about a major retailer in this category. They've got leases on hundreds of stores, supply contracts with thousands of vendors, payroll obligations to tens of thousands of employees. When they can't roll over their revolving credit facility because lenders won't extend at any price, the whole structure collapses simultaneously. Vendors don't get paid, triggering their own liquidity crises. Commercial landlords lose anchor tenants, can't meet their own debt service, and face foreclosure. The employees file for unemployment, stop spending in their local economies, creating more revenue pressure on other retailers. This is how credit crunches differ fundamentally from equity market crashes. When stocks fall, investors lose paper wealth. When credit markets seize, businesses lose the ability to operate. Your 401k might recover in 3 years. The job that disappeared when your employer couldn't meet payroll, that's gone permanently. The refinancing wall isn't just about dollars and maturities. It's about the systematic destruction of business models that only worked in a zero interest rate environment. We spent over a decade training an entire generation of corporate executives to manage businesses as if money would always be free. Borrow for stock buybacks, lever up for acquisitions, operate with negative free cash flow as long as you can raise another round of bonds. The capital structure optimization wasn't optimized for survival. It was optimized for a world that no longer exists. And now we're discovering what happens when the music stops and there aren't enough chairs. According to industry data, lenders extended $271 billion in commercial real estate debt from 2023 into 2024, hoping conditions would improve. Most of those extensions are back on the maturity calendar now for 2026, joining the new maturities and creating a wall of debt that physically cannot be refinanced under current conditions. The Bank of England noted in recent analysis that the SONIA bank rate wedge, the spread between SONIA and the base rate, has been moving in ways that signal stress in overnight funding markets. When this wedge widens beyond normal ranges, it indicates banks are paying premiums above the central bank's policy rate just to secure overnight liquidity. That's not a healthy market. That's a market pricing in the risk that counterparties won't be able to honor commitments. And here's what makes this particularly insidious. Unlike the lead up to 2008, where subprime mortgage exposure was concentrated in specific institutions, this credit crisis is diffused across the entire corporate sector. Every bank has exposure to commercial real estate. Every bank has corporate loan books filled with zombie companies. Every bank is looking at the same maturity wall and the same spread dynamics and reaching the same conclusion. Tighten standards now before we're the one left holding worthless paper. The Federal Reserve's stress test scenarios aren't predictions. They're preparations. When the Fed models a severely adverse outcome with specific parameters for spread widening and unemployment peaks, they're telling the banking system, this is what you need to be able to survive. They're not saying it will happen. They're saying it could happen. And you better have the capital cushion to absorb it. But here's the dark secret of bank stress tests. The banks pass because the Fed sets requirements they can meet with careful balance sheet management. The Fed doesn't test whether small businesses can survive when banks pull credit lines. They don't test whether commercial real estate owners can refinance when spreads double. They don't test whether zombie corporations can stay alive when the debt treadmill stops. The banking system survives. The real economy that depends on bank lending, that's where the $550 billion in losses actually materialize. Those aren't abstract numbers. They're failed businesses, foreclosed properties, liquidated assets, and destroyed livelihoods. The stress test tells us the banks will emerge intact after absorbing this carnage. It doesn't tell us how to avoid the carnage in the first place. And this is why that 18 basis points in SONIA markets matters so profoundly. It's the early tremor that precedes the earthquake. It's the markets telling us that the credit freeze is beginning, the refinancing wall is real, and the assumptions that kept zombie companies alive for the past 5 years are about to be stress tested in the real world rather than Fed models. You can't refinance your way out of a system-wide credit contraction. When every borrower needs to refinance simultaneously and every lender is pulling back simultaneously, prices don't find equilibrium. They collapse. Spreads don't stabilize. They explode. The math is terminal, and we're running out of time to position for what comes next. Let's do the math that Wall Street is desperately hoping you never calculate. According to the Institute of International Finance, global debt hit $315 trillion in the first quarter of 2024, representing 333% of global GDP. For every dollar the entire planet produces in a year, we we collectively owe $3.33 in debt. The International Monetary Fund's September 2025 data confirms this burden. 93% of GDP is government debt, 143% is private debt. We've built a global economic system that only functions if we continuously borrow more money to service existing obligations. Here's where the mathematics become inescapable. When debt was cheap and real interest rates were negative, this game could continue indefinitely. But we're not in that world anymore. U.S. Treasury data shows the federal government is now paying over $1 trillion annually just in interest on $38 trillion of debt. Average interest rates doubled from 1.61% in 2021 to 3.36% in 2025. Every quarter point rate increase adds $95 billion in annual interest costs. The Congressional Budget Office projects net interest payments will reach $13.8 trillion over the next decade, rising from $1 trillion annually in 2026 to $1.8 trillion by 2035. Interest costs are now the second largest category of federal spending, exceeded only by Social Security, more than defense, more than Medicare, just the cost of servicing debt we've already accumulated. And this is just the United States. According to the IMF's latest global debt monitor, emerging markets hold $105 trillion in debt, with their debt to GDP ratio hitting a record 257%. You can't grow your way out of a debt problem when the debt itself constrains the growth. The deleveraging supercycle has begun. Ray Dalio's framework on long-term debt cycles identifies where we are. Phase 5, where debt becomes so excessive that even central banks can't service obligations without devaluing the currency itself. We've reached the point where the system cannot generate enough real economic growth to service existing debt burdens at positive real interest rates. Japan learned this starting in 1990 when private sector debt hit 215% of GDP. Europe's peripheral countries discovered it during the 2010 through 2012 debt crisis. Now it's our turn. The combination of record debt levels, rising interest rates, and widening credit spreads creates a mathematical trap with no escape. You cannot simultaneously service $315 trillion in debt, maintain positive real interest rates, and generate sufficient economic growth to prevent default cascades. Let me show you what this means for traditional portfolios. The classic 60-40 allocation was built for an era where bonds provided ballast when equities fell. But when interest rates rise to fight inflation, bonds fall alongside stocks. When credit spreads widen, corporate bonds crater while equities collapse. The diversification that protected wealth for decades has been revealed as an illusion in a deleveraging supercycle. We're in the terminal phase of a 75-year debt supercycle where all paper assets move in the same direction, down. When those zombie companies start defaulting in waves, both your stock holdings and your bond holdings get destroyed simultaneously. So what do? There are 3 asymmetric plays that history suggests can preserve capital when everything else is being consumed by defaults and inflation. First, deep value in distressed senior secured debt. When companies default, senior secured debt holders have first claim on assets. During the deleveraging wave starting now, you can buy these claims at massive discounts from panicked sellers who need liquidity. We saw it in 2009 through 2011, when distressed funds returned 40 to 60% annually, buying debt marked to pennies on the dollar. Second, inflation-leveraged hard assets. When central banks face the choice between deflation or printing money to devalue debt, they always choose inflation. The Federal Reserve will not allow U.S. defaults on Treasury obligations. They will print. This means assets that benefit from inflation will dramatically outperform paper claims, productive farmland in stable countries, energy infrastructure with inflation-indexed cash flows, commodity producers with hard assets and pricing power, real assets that generate returns tied to inflation while paper wealth erodes. The key word is productive. Buying farmland that generates crop yields, or mineral rights that produce commodities, or infrastructure that collects tolls gives you cash flows that rise with inflation while paper assets burn. Third, physical gold and silver, not ETFs, not futures contracts, not mining stocks. Physical metal in your possession or in allocated storage where you hold title to specific bars. Here's why this matters now. On December 30th, 2025, silver futures hit $80 per ounce for the first time. Then in late January 2026, silver spiked to around $121 before experiencing the most violent single-day collapse since 1980, crashing to $78. Gold simultaneously fell from over $5,500 to around $5,000. The mainstream media blamed Kevin Warsh's Fed chair nomination, but market participants documented a far more disturbing pattern. As silver rolled over on Friday, January 30th, the London Metal Exchange experienced a pre-market glitch delaying electronic trading. HSBC, a major London Bullion Market Association participant, reported systems down in Hong Kong simultaneously. CME Group's Comex division hiked margin requirements on silver futures, just as liquidity thinned, forcing leveraged traders to dump contracts into a falling market. According to analysis from traders tracking these moves, JP Morgan appeared to close its silver short exposure almost perfectly at the intraday low. Remember, the U.S. Department of Justice and CFTC previously fined JP Morgan $920 million for manipulating gold and silver prices over 8 years between 2008 and 2016. The silver market has allegedly run a 164 million ounce annual supply deficit for 5 consecutive years, driven by demand from solar panels, electric vehicles, and AI data centers. Physical silver is disappearing into industrial applications that consume it permanently. Yet the paper market crashed 35% in a day. This is the signal you need to understand. The 18 basis points in Sonia spreads and the $80 glitch in silver are the same event viewed from different angles. Both represent the moment when the system begins purging its paper promises, because those promises have become impossible to honor with real assets. When credit markets freeze and banks stop lending to each other overnight, they're admitting counterparty risk has become unmanageable. When the paper-silver market crashes, despite chronic physical deficits, it's admitting the claims exceed the metal available for delivery. Both are confessions that we've created far more financial claims than we have real assets to back them. Gold crossed $5,000 per ounce, up dramatically from 2 years ago. Central banks worldwide are accumulating gold at record pace while selling U.S. treasuries. China slashed treasury holdings ahead to $730.7 billion, the lowest since December 2008, while gold reserves reached 2,303 tons by the third quarter of 2025. This isn't speculation. This is central banks voting with their reserves, moving from paper promises to hard assets. They understand what's coming because they have access to data we don't see. They know the debt can't be serviced. They know the credit markets are seizing. They're preparing for the reset by accumulating the only assets that have maintained value across every currency crisis in human history. Here's what the media won't tell you. The difference between paper claims and physical possession is the difference between wealth and worthlessness during monetary crises. When you own a gold ETF, you own shares in a fund that claims to hold gold. When you own COMEX silver futures, you own a contract that promises delivery. When you own mining stocks, you own equity in a company that might have metal someday. None of these are the same as holding physical metal. During the March 2020 crisis, gold ETFs traded at significant premiums to spot prices because physical metal became impossible to source. Dealers were sold out. Refineries were closed. People holding paper claims discovered those claims weren't convertible to actual metal at any price. The deleveraging supercycle will create this scenario at massive scale. As the credit system seizes and defaults cascade, the flight to physical assets will overwhelm the paper markets. Counterparty risk becomes the only risk that matters when financial institutions start failing. Do you trust that your ETF actually holds the gold it claims? Do you trust that your futures contract will be honored when COMEX faces liquidity crises? Or do you want to hold the actual metal stored where no counterparty can default on you? This is why financial advisors recommend 5 to 15% of portfolios in physical precious metals. Not because gold and silver are perfect investments. They pay no dividends, generate no cash flow, and their prices are volatile. But they're the only assets with no counterparty risk that have maintained purchasing power across every monetary crisis for 5,000 years. The math is terminal. $315 trillion in debt cannot be serviced at positive real interest rates with global GDP around $109 trillion. The credit markets know this, which is why spreads are widening. The precious metals markets know this, which is why physical demand keeps growing while paper prices get manipulated lower. Central banks know this, which is why they're accumulating gold while selling treasuries. Your final warning. The system is purging its paper promises. The 18 points in London, the $80 glitch in silver, the $930 billion refinancing wall, the Fed stress tests projecting $550 billion in losses, they're all telling you the same story. The deleveraging has begun, and traditional portfolios will be cannibalized by inflation and defaults. The asymmetric plays, distressed senior secured debt, inflation-leveraged hard assets, and physical precious metals aren't guarantees. Nothing is guaranteed in markets this chaotic. But they're the positions that have historically preserved wealth when debt supercycles unwind. They're the trades that protect against both the deflationary collapse of defaults and the inflationary response of desperate central banks. The exit door is closing, not because markets will lock you out, but because price is required to position for what's coming rise every day. Distressed debt gets more expensive as sophisticated funds deploy capital. Hard assets increase as inflation expectations rise. Physical metals become harder to source as mints sell out and premiums explode. The 18 basis points aren't a warning anymore. They're confirmation. The system broke, the math is terminal, and the reset is beginning whether we acknowledge it or not. The only question left is whether you'll hold the physical collateral when the paper promises burn, or whether you'll discover too late that you owned nothing but claims on a system that couldn't honor them.